You ready?
Yeah, let's do it.
All right, let's do it. Hi, I'm Tobias Carlisle. This is the Acquirers Podcast. My special guest today is Eric Cinnamond. He's an absolute return small cap value fund manager with with 2 decades of experience. He returned capital in 2016, citing a lack of opportunities in the market. He's just relaunched a new firm and a new fund. We're going to talk to him right after this.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers Funds or affiliates. For more information, visit acquirersfunds.com.
Hi, Eric.
Hey, Toby. Thanks for having me.
My absolute pleasure. I've been really looking forward to this conversation with you. Can you take us through the process of deciding to shut down the fund in 2016?
Well, it started with, the year with the precious metal miners doing very poorly. And that's really where I was focused on the equity side. And believe it or not, they worked out, and they worked out very well. And many of the 50-cent dollars were reaching fair value. And this was in the spring of 2016. And as they approach fair value, as an absolute return manager, what you do is when they reach fair value, you don't own overvalued securities. So I started to sell those, and cash reached very high levels, almost near 90%. And the remaining equities that I owned were fair value at best. There wasn't an adequate absolute return going forward. So sold many of the miners, was in the process of selling those. Cash reached extreme levels, and the future did not look bright as far as absolute returns. We were getting 0% on cash. That's before fees. So I thought the best course of action was to return capital, and that's what I recommended. And the firm went along with it, and we returned over $400 million. So I shut down an 18-year track record. So that was another very difficult decision.
So why shut down? Why not just carry cash, try and do something else, maybe reduce the fee or something like that?
That was possible, and we discussed that. However, I didn't have confidence in the end of this cycle. Rates were at zero. There was still global QE. And I didn't see a lot of late cycle signs that would indicate that we were approaching near the end of the market cycle. I'm not a market timer, but you have to be aware of where you are in the cycle. And to me, it just was we weren't there yet. And I thought, well, this could go on for several years. And I knew holding that amount of cash, for several years, not only would it not help our investors, but it would gradually ruin my track record because you're getting 0% for 3 years. That just wasn't very appealing to me. So I thought, again, best course of action was return capital. But it was a very very tough decision.
Yeah, I can imagine. I think you've probably been proven right that it wasn't the end of the cycle, and valuations are, if anything, they're probably more stretched now than they were then. So why relaunch a new firm and a new fund? The firm is called Palm Valley Capital Management, and the fund is Palm Valley Capital Fund, and the ticker is PVCMX.
Yeah, I mean, this has got to be the worst time to launch an absolute return strategy. There's not a lot of demand for our type of investing, but there were some special circumstances that occurred really in 2018 where a friend of mine, very bright portfolio manager, Jamie Wiggins, was let go as an absolute return manager. And Jamie and I talked about it, and I had no intention of coming back until valuations improved. Jamie was more of the mindset, let's launch before the cycle ends so we can take advantage of all the opportunities. It was a good argument, but the argument that persuaded me most was really just being around the same like-minded investors. That would be new to me, where the firm would be a pure 100% absolute return focus. And with Jamie and our other partner, Frank Martin, who's another very experienced absolute return manager. He's written a couple books. And I mean, when I was growing up as an investor, I used to read his annual reports. All I remember back then was they were so long. They were like 100 pages, but they were a very good summary of the year. So Frank was our financial backer, and we had Jamie, who's a very bright absolute return manager, and then myself. So we each own a third of the firm. And neither of us could envision another chance or opportunity for us to work together. I knew Jamie wouldn't be around for long, so we decided to launch. And it had been 2.5 years, almost. We're on 3 by the time we launched. Since I returned capital or recommended returning capital, and things have changed. I mean, short-term rates are higher. We're getting 2.4% now in T-bills instead of 0, so that's better. And I also, in 2017 and especially 2018, and I wrote about this in my blog, I documented this for over a year, there began to be more late cycle signs, where in 2016 I saw practically 0. In 18,
what are you seeing? What are you seeing in terms of late cycle?
I'm seeing tightening in labor. I'm seeing rising corporate costs and capacity utilization improving. You're seeing certain industries that have extreme capacity constraints. Maybe transportation is huge. So these sort of variables or these instances of late cycle indicators were not there in 16, and they were growing in 18. So I was becoming. I still don't know when this cycle ends, but I was becoming much more optimistic. That we were getting closer. So that helped me as well. And then you'll remember in 2018 into December, the Russell 2000 fell 20%. And I was so excited. I was like, oh, I can't believe this. We're launching right before this thing ends. And then of course we had the U-turn with the Fed, and there went all, and it wasn't like things were cheap then. It just, it was going the right direction. And so they took it all away, just immediately. And so now we're back to, holding T-bills and just waiting this thing out.
That was a funny period. I had a lot of people asking me, is this it? Is this the bottom? Like, should we be buying now? And I always say that that's the mistake, is just to shoot your bolt right at the very beginning of the collapse and not have any dry powder left when there's real value around.
I know, but that's what you want to do, right? I mean, it's been so long since QE3 is when things got a little nuts on valuations. I mean, more than a little. But I think that's one of the biggest risks at the end of this cycle is to get invested too early. Valuations are so extreme in small caps. If you get a 20% decline, you're going to be so relieved you didn't experience that 20%. You're going to want to get invested, but of course, valuation-wise, you could still lose another 30, 40, maybe even 50%. So you have to be careful not to be a little, you're going to be very, very anxious to get invested. But, our strategy is to wait till we get some real discounts and not relative discounts, which is what you were starting to see at the end of 2018.
It's one of the funny things about investing, that reverse compounding. I always point to the 1929 crash and say, if you waited until you were down 80% and then you invested at that point and the market proceeded down, it bottomed 90% from the peak. So even if you waited down 80%, you were down 50% in that 80 to 90 run. It's better than 90%, but it's still a big loss to take. It's extremely difficult to time. So can you tell us a little bit about your process and your strategy in the mutual fund or in the firm?
Well, it's an absolute return strategy, and that means a lot of different things to many people. But we have a specific goal we're trying to achieve. We say attractive returns over a full cycle, but our actual absolute return goal is 10 to 15% on our equities. So it's not just a goal. That's actually what we use in our discounted cash flow models. So, you've got cash flow over K minus G. Our K is 10 to 15%, with a 10 being a lower risk business and a 15% we're requiring a higher rate of return. And in the cash flow we use a normalized cash flow, because in absolute return investing, accurate valuations are very important. You don't want to make a lot of mistakes. So we'll use a normalized cash flow. We don't want peak. We don't want trough. We still believe in cycles. I know we haven't had a cycle in a long time, but we still believe they're there. And then the growth rate, we'll use a 2 to 5% growth rate because these are more mature businesses. We're not buying biotech companies, startups. These are just fuddy-duddy market leaders, mature businesses. They've been around. The average age of a company on our possible buy list is probably around 50 years old. But they're small caps because they're just unique, interesting niche industries. So that's our valuation model. It's normalized cash flow over our absolute return, required rate of return, minus our growth rate. So it's almost a perpetual bond type valuation. If you have a $10 million free cash flow normalized and you're requiring 15% for the business and you have a 5% growth rate, you really, all it is you're just capping it by 10% or
right.
a 10 times free cash flow. All multiples is K minus G, right? So that's how we do our valuation process.
And your universe is up to $10 billion in market cap.
Yeah, 100 million to 10 billion.
And do you know roughly where your average falls out, or do you know where you find most of the opportunities?
When I was running a considerable amount of money, it was about $1 billion average. Now that we're running very little at UM, we're just out of the gate and we haven't raised a lot of money. We're going to gravitate towards the lower market caps. What we're trying to do right now is stay away from the herd. We do not want to be, when this cycle ends, we don't want to be where people are being forced to liquidate. And that is going to be the ETFs, the passive funds, the index huggers, and all those small cap funds that have 100 names. We just don't want to be anywhere near that when that happens. So the smaller market caps outside of the ETFs, we are finding value, and that is because they haven't been driven up by the flows, into the ETFs. So those market caps we're looking at now are, more closer to 100 million, and some of them are closely held, and so the float's even less. But what's nice about these is the balance sheets. The balance sheets we're buying are incredible. Some are, 30-40% of the market cap in cash, and that usually only happens with a closely held business where you have a family who doesn't care. When an analyst tells them, hey, you need to do something with that cash, you need to buy back stock and take on debt, and the management's closely held, and they're like, yeah, whatever, go away, I don't really care what you think. And that's the kind of companies we're really gravitating towards right now.
What sort of industries are you finding opportunities in, and what sort of companies? Can you talk about names?
Oh, they're just so oddball companies. I mean, these little ones they're fun. I miss this because this is where I grew up when I worked at the Evergreen Funds in 96, 98. I grew up on a lot of these small, tiny companies, because when I was at Evergreen, we were running a $6 million fund, and you really could buy these micro caps, and they're so unique. They might be industry leader. They're just a tiny industry, An example would be Gencor. You would never guess what they do. They are the market leader in asphalt plants, right? So they have about 40% market share of asphalt plants, right? Market leader. Their market cap is it's about 170 million. So tiny market cap, but they have 115 million in cash and marketable securities, and they have 27 acres in downtown Orlando on the books. Back in like 1983. So and it's on the books for about $3 million, right? And if you drive down Orange Blossom Trail, which is the street they're on, and you look at the real estate prices on that road where a tremendous amount of traffic goes, you'll find that $3 million is significantly undervalued. So you could just buy it almost for the value of the marketable securities of cash and the land, and then you get the market leading business of asphalt equipment, which is extremely cyclical business, by the way, and cyclicality never bothered me, but it bothers some investors. An average asphalt plant costs about $4 million, right? So this is a very lumpy business, but 94% of the roads in the U.S. are paved with asphalt, so it's not going away. I don't know if they'll find a substitute for that. They haven't so far. It's closely held, though. The Elliott family has controlling interest, but great balance sheet. Very inconsistent revenue and cash flows, but if you normalize it, they'll generate 50 million near the trough, and they'll generate 100 million in revenues on the peak, and we'll normalize that and come up with about a $4 million a year in free cash flow, and then we discount that back, and we get a discount. It's not huge, but that's when people dump small caps. They're not going to be looking for Gencore. Well, they might. I mean, there are. This one has some ETF exposure or index exposure, but not relative to most of what we're seeing. Most of what we're seeing, many of the ETFs and index funds and closet index funds own 30 to 50% of the float. So when they all get outflows at the same time, they have to sell, and we just don't want to be part of that wave. So that's just one example, but it's a very unique industry, very unique business, and extremely different balance sheet because, as you know, the corporate balance sheets right now are a disaster. And when I think back to 2009 in March, the last time I got aggressive and fully invested, the balance sheets were so much better. I mean, so much better, especially with the cyclical names. Now, when this cycle ends, I think it's going to be much more difficult to get aggressive quickly because the balance sheets are just not there. I mean, you're going to have to. How are you going to survive the cycle with these levered balance sheets? So if next recession, next end of the market cycle, it's going to be a lot more difficult than '09.
Fortunately, the Fed has completely eliminated the business cycle, so you'll never need to worry about that again.
I keep forgetting.
I love that idea, though. That's exactly the kind of business that I like, basically, where you don't have to pay very much for a business, and it's a cyclical business, and you try and buy it a little bit below where the average falls out, and as it improves, you get a good return out of it.
Why do you think cyclicals are not appreciated by most value investors?
Hard to model, extremely hard to model. And I think what most people
they're considered poor businesses,
right?
But my point is, if you generate 0 and you generate 15 on the peak million, what's wrong with that? Over a whole cycle, if instead of just owning a 7% consistent growth,
well,
it's
Graham
the same thing mathematically.
I agree. Graham talks about taking an average of years to try to find the average earning power over the course of the business, whereas Buffett's sort of talking more about a compounder. And I think if you're looking for a compounder, then you ignore these companies. The problem is that there aren't very many compounders around. Most companies are more cyclical.
And the compounders this cycle have gotten so expensive because of 0% rates.
Right.
So it's a tricky situation. You almost are forced. And I remember I'm not a gold bug, but I remember the precious metal miners when they got cheap. It was the only thing around. I didn't want to be a miner analyst, but that's what, when you're a value manager, you got to go where the value was. And extremely cyclical businesses, but and no one was paying it. No one can career-wise own these things. So I think it has a lot to do with the career risk as well.
I agree with you. I think at that time we were doing something similar, and what we were finding is that for a lot of these names, you could buy them for roughly the cash on the balance sheet. You didn't have to pay much for the business at all. Yeah,
I was finding miners selling it like 4 times depletion.
Right.
You could live off the depletion if you wanted, if they had a good balance sheet.
That's another departure from many other value investors, that you are prepared to look at commodity type businesses. So what's your approach when you're doing something like that?
They did an attribution analysis at my last firm, and one of the areas where I generated most alpha was actually commodity stocks. And the reason for that, I believe, is because commodity stocks are either very in favor or very out of favor. Rarely are they fairly valued. And you can buy them at significant discounts, in the troughs. When oil was at $35 a barrel in 2009, or even a little less, that's where I was finding most of the value. And remember in 2008, oil was $140 a barrel, right? And these energy companies were trading at 3 times replacement costs. And then March of 2009, the oil was around $30 a barrel, and they were trading at significant discounts to replacement costs. So I could buy a barrel of oil in the ground for $10 a barrel, or I could buy an energy service company at 0.5 times book. And so what I was trying to do was trying to get a large discount to replacement costs of their hard assets. So I don't view commodity stocks on cash flow. If you do that, you're always going to buy them at the peak when they're generating a lot of cash flow, and you're never going to buy them at the trough when they're losing a lot of cash flow. But if you focus on the replacement cost of their assets, it's a much stickier valuation, because that doesn't change as quickly as the price of oil and natural gas or even the precious metals. So I've done very well historically buying them when they're in recession. No one wants them, and they're losing money. No one likes to buy business. See, that's another thing we're taught in school: never buy business that's losing money. But it's okay if they make money throughout a whole cycle. That's how I view things. Always over a whole cycle, never at the trough, never at the peak. So I think that's helped me a lot historically, buying them when they're very depressed. In 2009, I was 20% energy, March of 2009, and that was very aggressive at the time. But that generated tremendous absolute returns after that kind of cycle ran its course.
There's a Nordic oil and gas investor, Christian CM, and he has the same approach. He says you buy them when they're losing money and you sell them when they're making money. Definitely.
But it's you just think about buying the reserves at a discount. It makes it easier. Just like if you're going to the gas station, instead of paying $3 a gallon, you're paying $1.50. It's the same thing. It's just instead of it's at the pump, it's just in the ground. The storage is free. But again, they have to have very good balance sheets, because you don't know how long the industry recession will last, and it doesn't matter if you've got a 50-cent dollar if they go bankrupt, right?
Yeah. So
it's very important. The balance sheets are extremely important for cyclicals.
So when you're constructing your portfolio, how many positions, how concentrated are you prepared to get in any given name at inception, and how do you manage them as they go up?
We view things a lot of the times in terms of operating risk, financial risk. So operating risk being the cyclicality of the business, cyclicality of the cash flows, volatility of the cash flows, and then financial risk being the strength of the balance sheet. If I have a business with limited operating risk, limited financial risk, I'm very comfortable with a large weight, if it's at a discount. So those will be the 4 to 5% weights when you're finding discounts. The cyclicals, they have to be at a very big discount and have a very good balance sheet if I'm going to have a big weight. But normally those will be a lower weight if it's just an average discount. So I kind of weight them by risk, because absolute return strategy, one of the main things we try to do is not make huge mistakes, right? So if you have an extremely risky small cap idea that's at a discount, has a lot of operating risk, you better be sure you have a big discount and a great balance sheet to make that a bigger weight. But our weights would typically be, 1 to 5%. In 2009, the top 10 weights were about 40% of the portfolio. So concentrated when you have big discounts. In 2016, when I had small discounts, especially after the miners did well, those were 1 to 2% weights, because I didn't have any margin of safety. It was fair value, and when something's fair value, the only thing you're going to receive is that discount rate you're using in your model going forward. There's no gap you're going to close there.
In terms of, excuse me, I just lost my train of thought. Sorry. In terms of when a stock goes against you, do you buy more as it goes down, or how do you deal with something like that?
We do, assuming our valuation isn't in decline. If we made a mistake, because we do our valuations every quarter, and often when a stock goes against you, it's often after earnings report. And if we messed up on our cash flow assumption, if we didn't require a high enough required rate of return, or if we use too aggressive a growth rate, we will put that stock on probation until the valuation stabilizes. But if the valuation is in decline, we will not add to a position. And that has saved me, I can't tell you how many times, for myself. Because instinct, when an idea you've worked on and is right, it's right? And it goes against you. You want to buy more. Your ego wants to buy more. But having that, you do the valuation. All right, it's lower. We're going to wait a quarter now. Give it some time. See if the temporary issues are actually temporary. And I've often found the balance sheets will deteriorate even further, or they may panic and do an acquisition. It seems when a corporation is in distress is often when they do the wrong thing, So we would like to get through that period. When the valuation stabilizes, we will definitely, revisit and increase the weight.
I've heard on Real Vision interview that you keep a list of about 300 names that you would like to buy at a price, and you just track the valuations, and you don't buy them until you get your price. So how do you manage that process, and how many of those names are? I guess it varies from period to period, but how often are you checking in with those names, and how do you manage that process?
Well, we check the names every day. It's on a list, and we get the news every day. And really, it's a quarterly process for the valuations. We'll go through, their quarterly reports, read their conference calls, and it's on an Excel spreadsheet, the rough valuations, and it can alert you when those valuations, are making sense again. But to be honest, most of the names on the possible buy list right now are extremely expensive, and the average PE is close to 30 times, and the average price of sales is a little over 2 times. So, it's not like I have to watch the buy list right now and, oh man, today's the day. We're so far away from real discounts, from genuine discounts, that it's not really, it's not productive watching that list right now. But what's very productive about the list currently, I find anyways, is monitoring the results of the companies, monitoring the conference calls, and getting a good feel of where we are in the profit cycle, which helps us normalize cash flows. So we view the economy through the eyes of business. We call ourselves bottom-up economists, which I really like. I think you can get a good, really very accurate and timely view of the economy through following so many names. Another thing that's helpful by following all these names.
Just before you go on, what is that telling you about the cycle right now? What are your insights?
Well, 2018 was extremely interesting, and it was the first time since the middle of 2014 that I saw very strong operating results of the companies, very broadly. And that's the first time, and when we talked earlier about some more end of the cycle signs, where companies were openly talking about cost pressures, price increases, inability to find sufficient labor. Things were really strong. And then Q4, we had the market sell-off, and this shows how correlated the stock market has become to the economy. Things became much more mixed in Q4 of 18. And then Q1, I just finished, and your listeners are welcome to email me, and I'll send them a summary of the buy list highlights. It's like 108 pages, but I think a lot of people would like it. But the beginning of Q1 19 started a little weak, but started to gain momentum at the end of the quarter. And I think that may have been what saved the quarter from a GDP perspective. And then it's very, very correlated to the stock market, because a lot of companies talk about a slow beginning, a slow Q4, and then a ramp up as there's a little more clarity, really, I think, with asset prices in February, March. So it's showing, I think what it's done is it's sort of proven how dependent we are now on asset inflation. And you can see with the home builders too. The home builders were very weak, not very weak, but weakening in Q4, early Q1, but then started to rebound in the spring selling season. I joke with a friend of mine, actually Frank Martin, one of our founders or owners. He does things from the top down, and I view things from the bottom up. I said, Frank, I think we both have this wrong. We should just be looking at the S&P 500. That's the next recession we have. I think we'll be down 30, 40%, 50% on the S&P, and then we can claim we know we're in a recession.
Is your benchmark the Russell 2000? Is that roughly the universe that you're drawing from?
It is, because we're required to have a benchmark. Actually, I think it's Morningstar or something or another. Honestly, I don't even know what our benchmark is because I don't pay attention to it. Sorry. Yeah, but that's the whole key to the strategy. You can't be concerned about the benchmark, because relative return investing, in our opinion, just isn't the best way to get through a cycle. So if you don't care about a benchmark, what do you care about? And what we care about is generating that attractive absolute return over a cycle, and specifically the 10 to 15% required rate of return on our equities. right? That's what we're concerned about. And if you can't achieve that, if 10 to 15% is not achievable because prices are too high, you just don't do it. You're patient. You wait, right? But most people, most investors, most strategies have mandates where that's not allowed. But so that's how we view it. We don't obsess about relative performance. I was talking to a portfolio manager once, and he said, Eric, how you doing today? And I said, I'm doing great. How are you? He said, no, how are you doing? I said, doing well. And he said, how are you doing? And I said, I don't know what you're talking about. He said, relative to the Russell. I said, I have no idea how I'm doing relative. But this is the obsession we have as an industry. It's not just quarterly, yearly, 5 years. It's today at 2:30. How are you doing?
How are you doing since lunch?
It's so short-sighted how our industry has gotten. But we're in a period now with this industry where if you underperform you get put in front of a board and have to explain yourself, the risk management committee. So it's very difficult to run money this way. And we are very fortunate to have a firm now where we're isolated from that. It's so, I can't tell you how refreshing it is just to not have to deal with the relative return mindset.
I might have misspoken. I sort of meant, your universe is below $10 billion, but what does that roughly equate to in terms of a better known index? Do you know?
I think it would be similar to the Russell 2000, but a little higher I think the Russell 2000 market cap might close around 6 to 8. And one of the reasons we want to go to 10 is obviously there's more the better, to look through. But what I found in 0809 was many of my ideas I purchased in 0809 in the crisis were mid-cap stocks before, right? So I want to be familiar with the bigger caps when they come down to our sort of, our core area of competence, and that would be small caps. I remember someone called me, a journalist, and they wanted me to comment on General Motors. And this was in 2008, 2009. I said, I'm a small cap manager. I think you got the wrong guy. And he's like, General Motors is a small cap now.
How big was it?
I don't know, but it had to have been below 5 billion. So, on their way to distress, they became a small cap. And so that can happen in a crisis. Again, some of my best ideas were mid-cap stocks in the 08-09 period. And we're hoping for that again.
It was a $5 billion market cap with $200 billion in debt. On an EV basis, it was still a pretty big company.
Yeah, pretty big EV.
A mutual friend of ours, Jesse Felder, introduced us, and he shared a chart of yours, which I think was drawn from the Russell 2000, showing the EV/EBIT or EV/EBITDA multiples stretching back maybe 20 years or something like that. And it showed there was this hockey stick in about 2013 when valuations really went bananas. So can you just talk a little bit about that chart and what you deduced from that?
It's a great chart. And I give credit to Jamie Wiggins. He's the co-manager of the strategy. He put that together. I had that similar with the possible buy list, just using the average. But Jamie's a median guy, and he likes to use median, but I thought it was very good. But you're right, 2013, QE3, that's when things got crazy, from a valuation perspective. And that's really when, I had a very good 09 to 12, combined, or 08 to 12, even 07, but lagged considerably from 13. And really it was 2013, I got smoked in 13. And, you couldn't come up with genuine discounts. So we had a lot of cash and the market went crazy. So that's one of the risks of this strategy actually is, sort of that opportunity cost, being patient while the market is marching higher. But no, that's a great chart, and it shows several things, just that how you could easily lose half your money just if we go back to average. I mean, I don't think people realize when allocating money to small caps and they're buying the ETFs that you are actually risking at least half of your capital just if we go back to normal. The other thing I like about that chart is it uses EBIT. And the reason I like that is we have extraordinarily low interest rates right now for these small cap businesses where people are lending small cap companies debt for an extended period, at 4-5%. Many of these companies, were almost bankrupt in 08, 09. It wasn't that long ago. Now they're getting a free pass almost on credit. So I don't like to use, I like to normalize things, and I would like to normalize interest rates if I'm going to value these companies. And the other thing is tax rates. Tax rates, near 20% now, 21%. You have to ask yourself, if we're going to generate or have $1 trillion deficits partially because of these tax rates, are the tax rates sustainable, right? So if you believe tax rates are not normalized or too low, interest rates are not normalized or too low, it's a pretty good idea to focus on either price to sales or price to enterprise value to EBIT, because that kind of weeds that out and gives you, I think, a truer reflection of valuation in a more normal type environment. So that was a great chart. I wish I made it, but that was Jamie.
It's music to my ears because that's my favorite metric. That creates an unusual opportunity set then, because you have, if you do all of that normalization, normalizing taxes, normalizing interest rates, which I think, and normalizing earnings for peak cycle, there can't be much left that's undervalued, if anything.
No. And that is our problem. So, again, returning capital to 16 because we're not finding value. To be clear, we're not starting a fund now because we're finding value. Actually, there's less value now. I mean, there's just no value except outside of the benchmarks. We've talked about the lower market caps without the ETF exposure. There are some unique situations. We're gonna own a handful of those, but our main goal at this point is to be defensive and then get aggressive. So we can't do really well on the absolute return side until the cycle ends. But we're so optimistic that when it does end, it's going to be wonderful. And for the patient investors that have waited so long, I'm so excited about what is in front of us. And each day that passes, I know we're getting closer. So it's a neat period for us. We're all really excited, and we're waiting in T-bills and some wonky small caps that are just fun to follow. So it's a neat little portfolio, and we think we're positioned perfect for the end of the cycle. The key for us, we talked about this earlier too, is when prices start to make sense again or getting close to that, is how we respond and how quickly we respond. And do we allocate capital too quickly or too slowly? So this is going to be a tricky end of the cycle. I don't think this is going to be as easy as 08, 09, when there were so many good balance sheets. You could just throw a dart and make money on a good balance sheet business that, is down 60%.
I commend you for the approach. It's an incredibly disciplined one and a difficult one to do for the fact that, like, James Montier, who's an analyst at GMO, he wrote this great paper called about financial repression, and he said you've got two choices, and they're not great choices. One of them is if you think that this is going to persist for a really long time, and he had some data that showed that these things can last for 2 or 3 decades, which made me a little bit nervous. You have to sort of, if you think that that's the case, then you sort of need to be fully invested in wherever you can be, or you think that more likely, well, not more likely, but or you think that that's my bias right there, or you think that at some stage we get the normalization, or we get a crash basically, and then you take your opportunity to do it then. And I honestly I don't know. I think that a crash is much more likely, but I don't know.
Well, and we're not 100% confident either. But think about it this way: even if it's a 50% chance. How are most people positioned right now? I would say 95% of people are positioned as if there's never going to be a recession again, never going to be a bear market again. You think it would be a little more balanced. So hopefully with our strategy, we're at least providing people with an option if you want to diversify away from that fully invested mentality. But that's our business. Our industry. Fully invested is a mandate for many. They don't have a choice. There's a lot of managers, analysts that believe small caps are overvalued, but they can't hold cash or they will get fired. I mean, there was a portfolio manager on Bloomberg TV last night saying that he was going to de-risk his portfolio and move cash from 1% to 5%. And I was like, whoa.
Is that selling a position? He sold something.
He sold something. But that's the mentality now. It's people have been burnt so many times for being conservative, and even if they believe things are overvalued, if they invest that way, they have lost their job. Many people, or shut down funds. So it's extremely difficult, and that's what happens at these cycles, and why I don't believe it's perpetual. Is money or capital is taken away from people like us who believe in cycles and believe in we don't believe in overvaluation will persist indefinitely, and eventually that capital is fully allocated to one side, and that's the risk takers and the people that are aggressive near peak valuations. There's just no more capital to take from people like us. I was running $1 billion at one point, and I don't even want to tell you what I'm running right now.
Big opportunity set.
We're tapped out. They've taken it from us, and I guarantee it didn't go into T-bills, so they took it. It's probably in a fully invested ETF somewhere.
It's been a very tough decade because there was a wobble in 2012 that didn't really turn into anything. There was a wobble in late 2015 that looked like it really could be the thing, but then the market took off in 2016. And then again, last year, there was that down 20%, bounce like a golf ball off a concrete path and just took off again. So how do you manage through a period like that? I mean, you sort of stepped away from the table, but if we see that again, what do you do?
Well, I think that the 3 years off have definitely helped me. Just stepping away from it for a while, and I didn't lose anything for waiting. Prices kept getting more expensive. So, but you're right. I mean, every dip is bought, every dip is rewarded, and of course we know why. It's central banking and their continuous effort to keep asset inflation growing, and there's so much at stake. It's going to be, they're not going to go down. I mean, they're going to go down swinging. So you have to anticipate further policy intervention. It's going to be aggressive. So that's that's part of the deal. But one day, I'm still a believer in cycles and markets and free markets. I think they're bigger than governments. And, I don't know what's going to happen or when. But to me, just the thought of creating value without sacrifice or effort or creating money, it doesn't make sense to me. How can you create something indefinitely without making a sacrifice or effort and it be considered wealth? So I think at some point there will be unintended consequences. I'm seeing it now with cost pressures and inflation. I know it's not showing up in the data, but you're seeing it with corporations. So I'm optimistic in cycles, and I'm optimistic that human nature hasn't changed. And, we will have a recession again, and we have a lot of debt. I mean, a lot of things that have gone on this cycle that are very reminiscent of past cycles where human psychology extrapolated. That's the thing about these cycles. We just extrapolate what's going on today so far in the future, but the future is not like today. It's going to be different. And I don't know how different or what the catalyst will be, but to assume that everything is going to be the same and that every dip will be rewarded and that every central bank intervention will have the same result, I think is being very naive, and I think goes against history. So I'm still in the boat of cycles. I know I'm in a minority. I mean, what are your thoughts on this?
Well, I think there must be a cycle. I don't have any more evidence than anybody else, but I look at, there's been constant central bank intervention, not just from the US Federal Reserve, but from the BOJ and the ECB, and they've basically been handing it off one to the other pretty consistently for the last decade. And they've been running it like we're in the very depths of the recession. And that's the thing that makes me most nervous, because I keep on looking around and it looks pretty good to me. And
exactly.
So what do we do? Sense. What do we do if we actually go into a recession?
I mean, we're GDP at 3%, companies are having difficulty finding qualified labor.
All-time low unemployment.
I was reading a conference call this week. Was it Patriot Transportation? They had to shut down a transportation hub in North Carolina because they couldn't find enough workers. And here we are. The market is pricing in a rate cut. It's like, what is going on?
And Powell's out there saying, "Don't worry, everybody relax."
Yeah, it's like you look at the economy, you look at the companies, and you look at the tightness in the labor market, and then you see the narrative forming for a rate cut, and it's almost like they're panicked almost to keep asset prices inflated somehow, some way. And that's just, to me, desperation. And I just don't know if that is a long-term policy. This desperation of maintaining asset prices. I remember March of 2000. I came into work one day. I mean, epic bubble, epic technology bubble. Went up every day. Every stock I owned went down. Every technology stock went up. I mean, by a lot. And I came into work one day, and the internet stocks were crashing. And there was no reason. It's just you came into work one day and everything changed. And once it changed, there was no going back. The psychology shifted, and it was over. The technology bubble popped. And there was no warning. Everyone that owned them, all my friends that were millionaires on paper, but it just happened immediately. And no one's thinking that will happen, right? I mean, you just walk in one day and you see the long bond down $5, because the bond market's revolting or the currency market's in disarray. I don't think anyone's anticipating that, but sometimes that's how cycles end without notice, and they can be violent.
What was it like managing through a period like that? Because there aren't really that many people who've been around in the markets as long as that they were managing through that late 1990s bubble. Because on one hand, you were finding the kind of stocks that a value investor loves to find, undervalued, good business, throwing off lots of cash flow, but they just weren't going up. Whereas you had these other pretty junky businesses that were running to the moon. Yeah.
And my dad used to say, if it's not one thing, it's another. But I'm telling you, I mean, things were so cheap in 08, 09, 99, 98, 99, there was a lot of value in small caps. And so you had a fully invested portfolio of these wonderful businesses generating cash, selling at 8 to 10 times earnings, and you get big dividends, and it was just wonderful for a value investor. But they went down every day. Like you were, I was an idiot, And technology stocks were up 80% in '99, 80+%, and I was down 8%. So that was the first time in my career that I looked. Before that, I thought I was a genius because I had the profit cycle from '93 to '97 bailing me out, and I thought I was a genius because nothing went wrong. But all of a sudden, I became this idiot that didn't understand investing, and I went to the dermatologist because I had a piece of hair missing in the back of my head because of the stress. My immune system was eating my hair follicles.
No kidding.
Yeah, no kidding. And I went to the dermatologist, like, what is stressing you out? And I said, have you seen eToys? I said, it's $85 and not making any money. It's like $100 billion market cap. And the dermatologist was like, about to send me to a shrink. But he said,
he's like, I own it.
He said, if you don't stop obsessing about this technology bubble, he said, you're going to lose every hair on your body. I said, great. That's what I wanted to hear. So the technology bubble popped, and all my hair grew back, but and then did very well 2000, 2002, because all those discounts, not only did they not go down in the bear market of 2000, 2001, 2002, they did very well. So I had great performance after that, but it was a very difficult period to get there. And then, of course, the housing bubble was similar, but you had to hold a lot more cash because valuations were much broader. And then this cycle, you have to hold even more cash because I don't know who termed the everything bubble, but I think it's a great term. I wish I came up with it. But I think that, pretty much sums it up. You have to own a lot of cash this cycle, too, because everything's so broadly overvalued. So they all have these rotating asset bubbles we've been living through all have a unique set of challenges, I think. They're all similar to one respect, and they're tied to policy, but they all behave a little differently. So you start to position differently for each one. Like you can't just hold cash for each one. Holding cash didn't work in '99. Owning undervalued equities worked great. So each one you kind of have to adjust.
It's been one of the maddening things about this cycle has been the I forget who said it, it's Peter Lynch or it's Graham who said something like you find the thing that you like, sounds more like Lynch, you find the product or whatever that you like, and then you don't just go and immediately buy the stock. What you do is you go then and you find the company and you do a valuation on the company and you see if it's something that you want to buy, and that's how you create your portfolio. That sounds more like Lynch. But this time around, if you did that second step and you went and found a valuation, that kept you out of Facebook, Amazon, Netflix, Google, So that's the most maddening thing about this one. I've got a friend of the firm, Phil, back at Exponential ETFs. They have a American customer service ETF where basically they can judge the earnings a quarter ahead, roughly based on the sentiment of people who buy these various products, and they can map them to the products. And there's a competing ETF in Europe that does something similar, except they do another step where they go and then do a valuation. And so the one that doesn't do the valuation massively outperforming the one that does.
Of course. The last thing you want to do right now is do a valuation and stick to it. It's not been very helpful. I was talking to the co-manager yesterday. He was working on an idea, and he's like, "It looks like it's at a discount right now." And I said, "Stop right there! Don't do any more work." Because I know you're going to find something, and we're not going to be able to buy it.
It's been
valuations right now have not been helpful in anything. The past 5 years or so, it's been a hindrance. So
being a value investor,
but what bubble has that not been the case, right? You could do the same thing with real estate last cycle and tech stocks the other cycle. But in the end, it was everything, right? Not overpaying was everything at the last two cycles. So we're sticking with that overpaying is the largest risk to investing. And historically, that's always been the case. If it changes this cycle, overpaying is rewarded for the next 20, 30 years, then we're all done, right? Active management's done. It's over. But we're gonna stick to that. We're gonna go down swinging.
It's been a very rough 5 years for value investors, just because it's been such a long cycle where value hasn't worked. I think it's the longest that I can find in the data. And it makes me, I think that it's sad because it's meant that a lot of value investors have kind of left everybody's shutting down.
Well, who do you respect now? I mean, I'm having trouble finding people I respect in the industry. A lot of them have disappeared. Some of them have passed away. And some of the greats, I just scratch my head sometimes with the things they're saying. So they'll say one thing and then invest differently. So I just feel a little, and this is what's nice about our new firm is we've got 3 absolute return managers who are very like-minded and very true to their discipline. But I'm finding sort of that class of people that got the technology bubble right, people that got the housing bubble right. They're all different directions now. Everyone's gone so many different ways because this cycle's been so long. I think after 5 years, you're like, oh, I gotta change, because this isn't working, right?
You're out of a job.
You're out of a job, or mentally, it's hard to maintain that for so long. So I'm struggling now, and that's why I love this alternative media you're doing, and I know Jesse Felder does it, and I think it's great. But it's nice because you can kind of find in that community where there's still some people that think the same way, or haven't given up.
Can find a handful of weirdos who haven't given in yet.
Exactly, it's a support group.
My
name is Toby. I still believe in cycles.
I do, and value investing. Which is just you're a complete laughingstock now if you believe in value investing. I always say there's nobody from my vintage who's famous because there are no well-known value investors from my vintage beforehand. So there's Ackman and there's Einhorn, Dan Loeb, and they're all sort of activists, but that was the cycle too. But there's really nobody who's been able to establish a track record below those guys who's sort of in the market now.
Yeah, and credibility expires. I remember after a technology bubble, credibility high. By 2005, I was an idiot again. And then after the housing bubble, credibility high, and I'm back to being an idiot again. But the key to absolute return investing and discipline in investing in general is the willingness to look different and the willingness to look stupid. It's very important. So if you're uncomfortable with that, you might as well just go with the flow, right? So if you're going to be a great investor, you can't look like everyone else. It's impossible. I mean, all these consultants want lower risk, higher returns, but they want you to look the same while doing it, right? So it's impossible.
It's fun.
So you have to be different.
It's funny the number of times that I've spoken to allocators, even allocators who allocate to value, and they say, here's what we want. You've got to be looking for compounders. You've got to be looking for moats. You've got to be looking for high return on invested capital. I had a call last night where the guy was describing it to me. And I always say, like, aren't you concerned that you're going to get 10 different investors who hold exactly the same portfolio?
That's right. You've got to be in a box. That's one thing I learned after the technology bubble. We had great performance. We tried to sell it to consultants. And if you didn't fit the mold, because if you hold cash or you don't have sector weights, you almost have to build a portfolio if you want to make a lot of money professionally. You almost have to build a portfolio that you can sell, right. Not how you believe it should be run. It's two different things. And how are you a fiduciary in this market? I mean, how can you be a fiduciary in this market and be fully invested, right? I have a hard time with that whole concept. But if you have mandates requiring you to stay fully invested, can you be a fiduciary? Can you adhere to your fiduciary duty at the same time? I don't think you can, and that's very interesting, especially for regulators. When this cycle ends, there's going to be a lot of questions to be asked and maybe some things to change where you provide managers more flexibility in these rotating asset bubbles to protect capital. Because it isn't right now, there's no focus on protecting capital, but there's a lot of focus on keeping up with the benchmarks, right?
Right.
But that needs to change. And I know we've had 2 cycles where that should have already changed. But this one, because things are so broadly overvalued, I really think we need to have a hard, really thoughtful discussion on this, on fiduciary duty and the conflict with these mandates of being fully invested, sector weights, almost requiring you to stay committed.
And it's so extended. So anybody who's an adult in the room has a terrible track record because they've been underperforming and carrying cash.
Oh,
yeah. Well, you don't know what you're 50%, you're 100% behind the market. What do you know?
Yeah. Well, I was very lucky. I cut my track record off at 16. So now I didn't have to go through this. I was like, hey, it still looks pretty good. But if I went through it to 19, it probably wouldn't have held up so well because I would have been all cash.
Must have been incredibly tough to walk away from that 18-year track record.
It was extremely tough, but I didn't really have a choice. You either overpay or you don't, and if you overpay, I would have more trouble with that than leaving the track record. So, and we're not overpaying now, which is nice. We just don't have many stocks. We got a lot of T-bills. So,
well, Eric, we're coming up on time. Can you, if folks want to get in touch with you or they want to read what you're writing, where do they go to find you?
We got a website, Palm Valley Capital, and we got a blog on there. I'm still writing a blog, which I was doing. I was still keeping track of my names, 16 till now. So yeah, just go to our website and feel free to email me or give me a call.
And we'll put your contact details in the show notes for this show. But thank you very much for the time, Eric Cinnamond.
Enjoyed it. Thanks, Toby, so much. Appreciate it.